Welcome to my Introduction to Investing series. I first started this series 10 years ago, so you can call this version 2, a bit more updated, produced, and touched up. I started the series with the same question: why do you want to invest? Very few would-be investors stop to ask this question. What is your actual goal? What do you think is your probability that you can achieve it? Is it worth your time to learn this new discipline? I hate to burst your bubble, but I think 95% of people come to investing with the wrong motivations and a poor understanding of what it takes to be a successful investor. Let's go over those misconceptions. Investing is an easy way to get rich. Buying an index fund guarantees success. A few minutes a week is all it takes to be professionals. That a lucky start means you have skill. I also think most investors don't think about their goals seriously enough. You might be thinking, this guy's crazy. Everyone knows why we should all invest: to make money. But this is dead wrong, and this thinking is the cause of so much misery. There are many, many ways to make money. And in general, if you glance at the Forbes list, the very richest people made their money building, creating, and inventing things they love. Of course, there are some investors there, but funny enough, most of the people who built investing companies, more than they practiced investing, became very wealthy that way. Some very few actually did compound their way to fantastic wealth. While investing can lead to great wealth, so can any other discipline. Doctors make tons of money, so do restaurateurs and lawyers. Why do you want to invest? Oh, I know why. You may have some money tucked away and you'd like it to grow, perhaps to beat inflation at least. You've heard about the miracles of compounding interest and returns. Well, that sounds reasonable. Unfortunately, you'd be wrong again. Compounding wealth in a meaningful way requires enormous risk. You're almost certainly better off focusing on making wealth with your actual talent. Investing will distract you and, at best, earn you a percentage point or two more than the returns you would have gotten otherwise. There is variance, of course, and some people will do handsomely investing, but others will make a wrong step and be ruined. Why am I so pessimistic? I'm not really. I'd love for you to watch my videos. I just want you to understand that there's no light switch you can flip and make 10% a year from here on out. What then is realistic? Well, in the coming videos, I'll go deeper into returns and risks and how to decide what stocks to buy and things like that. But I want to set your expectations now. Historically, even the best investors, the real professionals, consider 10 to 20% annual returns to be outstanding performance. That's without taking absurd risks. For the average investor, realistically, you should expect returns that barely outpace inflation, maybe 3 to 5% a year after taxes and fees. If you hear somebody promising consistent double-digit returns with no risk, they're either lying, deluded, or both. I really try to focus on showing you how professional investors invest. This is more of a training course for people who want to be full-time professional investors. I don't think you can just invest from your cell phone, every now and then and hope to make good returns. I don't think that'll work at all. Professional investors train for years just to eke out a few points of outperformance. That's how tough this is. I'll cover all this in more detail soon, but I want you to keep a grounded view about what success looks like. It's not about getting rich quickly. It's about building wealth slowly, methodically, with skill, patience, and a deep understanding of risk. There's another reality you need to understand. Most investors aren't starting from a fortune. The very richest people you've heard of, like people like Michael Dell, Bill Gates, Carl Icahn, George Soros, these are people with family offices. They didn't grow their wealth from a few $1,000s into billions by picking great stocks. They built massive wealth by creating businesses. Only after that did they become extremely wealthy, so wealthy they could afford to invest only their own money through what's called a family office. You and I, and most people starting out, don't have that luxury. If you want to become wealthy through investing, you almost certainly need to manage other people's money. OPM. Hedge funds, private equity, venture capital, they all work that way. Even Warren Buffett technically has OPM. He's not the only shareholder of Berkshire, for example. If you think you're going to turn $5,000 or $50,000 into a fortune through compounding alone, you're setting yourself up for disappointment. Even a fantastic 10% per year return compounded over decades would be respectable, but it's not really life-changing unless you already have millions. So here's the hard truth you need to wrestle with. If no one is willing to pay you for your investment advice, why are you trusting yourself to take your own advice? Or flip it around. If you're truly good at investing, why isn't someone hiring you to pick stocks or manage money for them, or at least help them? That's the real market test. Investing isn't about convincing yourself that you're good. It's about being so good that other people recognize it and want to bet on you. If you keep that standard in mind, you'll avoid years of costly self-delusion, and you'll aim at the only target worth shooting for, which is real skill, real mastery, and eventually real wealth. There is a pervasive myth that if you just buy the S&P 500 or dollar cost average, or as some will say, that you'll do well. Historically, this has been somewhat true, right? Well, let's take a look. US equities have had positive returns over the last century, around 7%. The problem is inflation has eaten away at that return. And while stocks may have compounded 7%, inflation compounded 2% along with it. Next, there are taxes. If you plan on needing that money, you'll be levied anywhere from a 15% gain to 50% gain on capital gains tax. And by the way, you don't get a refund if you lose money. So you're down to 4%-ish at best, and possibly as little as 2.5%. Doesn't sound so great anymore. But the biggest problem of all is that you've taken a massive implicit risk. You're assuming 2 points, 2 ideas that are wildly risky. The first is that the United States is a special place. Don't get me wrong, I'm a proud American. But the American markets have done superbly well because the US has been a special place. It may not continue to be one. Do you know history and sociology? Do you know what conditions are required to sustain economic growth? Have you considered that every empire falls? The United States may very well equal, exceed, fall short, or completely fail with respect to equity returns going forward. It really isn't possible to know what the future will be without a crystal ball. The past is gone. The past is a certain set of conditions that won't repeat itself. There's also a size problem. The US was a very small country, it could grow very fast. Now it's the biggest country in the world. Expecting it to grow extremely fast is unreasonable, and it gets more difficult as the country gets bigger. So passively hoping the S&P 500 will do well is no different from faith. We don't do faith here. That's the wrong channel. The second big assumption you're making is this long-term average return is somehow relevant to you. Even if the US will, on average, return exactly the same as the last 100 years, in the next 100 years, there's some surprises in store. First, you don't know what inflation or taxes will be. Next, there have been decade-long periods in the US where investing where investing in the market had real returns close to or even less than zero. There's no guarantees that won't happen again, or won't happen for, say, 20 years or 30 years. You could still get that 7% over 100 years, but what if there's a 10, 20, or 30-year drawdown where there are no returns? People are generally awful at statistics. We assume the past will repeat itself. This reminds me of the story about turkeys. The turkey sees the farmer come in and feed them. They get excited. Every time the farmer shows up, they're excited that they'll be fed. This happens for 364 days. Finally, on one day, namely Thanksgiving, the farmer shows up, but he's not there to feed the turkeys. Avoid being the poultry in this story. Consider the difference between mean, median, and index returns for stocks as well. There's a big difference in those. So what's the answer? Just use blind faith and go all in on equities? You could do that if you want. You won't need to watch the rest of my videos. Your financial advisor will take it from here. Do you give up and focus on your career, as I mentioned? I think that's reasonable advice. The time you spend chasing returns will probably be fruitless. Or do you learn how to invest like a professional from a professional? What would be the reasons for doing this? I've taught investing for a long time, even while I was learning it and perfecting it. The only reason I've thought of that is reasonable over these years is that you should learn investing if you want to become a professional investor. To me, that means you're going to invest professionally, as a career, all day, every day. Could you do it as a serious hobby, perhaps? Maybe if you're retired. Yes, it's possible, but I only advise it if you have nearly all of your free time to spend on it. This isn't some game or joke. I want you to think about investing in a new way. Pick your favorite sport, maybe baseball. Investing well is just as hard as going to the major leagues and pitching for the Yankees tomorrow. Are you ready to throw 90 miles an hour against the toughest hitter? I'm not. You're not. The only people who can do that have been practicing their whole life with the best coaches, and they have enormous talent. Do you have the talent? Do you need the talent to invest? This is debated pretty intensely among professionals. My short answer is, I don't think it hurts. And when I say talent, I mean natural talent. Preparation and training is necessary too. But natural talent is, some people feel, is like actually something required that you can never get. from training. Let's go back to baseball. If you decided, you know what, Martin, I want to give it a shot. I'll pitch tonight against the Mets. The problem is, of course, no one would let you. No one's going to go through the whole production of turning the lights on at Yankee Stadium and organizing the game and selling tickets because nobody would come. But investing is a funny game. Investing is like a game of Major League Baseball where the professional batters are more than happy to play with you. Imagine Babe Ruth and Derek Jeter and Aaron Judge, star hitters. They're thrilled to be there. They know you're pitching tonight. The thing is, there are very few barriers for investing today. With brokerage apps, you can get started right away. You can play this game with the very best players at any time with a few clicks. That's all it takes. Absolutely no one will stop you from throwing your whole life savings at terrible investments. Because there's so much money at stake, especially when your money is pulled in with everyone else's, that professionals are delighted to play the game with you. They want you to play. And it gets worse. In baseball, you or I would miss the strike zone completely, right? With our terrible pitching. I'm not even sure I could throw it to the mound. If we did throw it, in the right strike zone, we'd probably get lit up each time, giving up home run after home run. Not so in investing. You may throw a strikeout in your first inning. Normally, that would be incredible. You must have a knack for pitching. But in investing, your first little success will probably be random. And this will probably lead you to believe you have skill when you don't. The easier something is to start, the more people underestimate the difficulty of mastering it. It's the illusion of simplicity. Clicking buy on a stock app feels like a game, but it's a professional blood sport. Consider chess. You may be able to learn how to play it in a day, but you wouldn't want to play Magnus Carlsen for money. The stock market is like playing the best chess players in the world for money. You better be prepared. And here's another very dangerous trap: beginner's luck. In investing, you might win your first few trades. You might double your money once or twice. You might start to think you have the knack, that you're naturally gifted, that you figured it out. You haven't. Randomness is a cruel trickster. Early success is often pure chance, not skill. And believing otherwise can lead you to taking on bigger and bigger risks, right before the market teaches you a brutal lesson. If you ever start to feel invincible, that's when you're at the greatest risk of blowing yourself up. And it's not just beginners who fall into this trap. Many professional investors build strategies that work well for years, sometimes decades, without realizing they were simply riding a style that happened to perform. Some will sell volatility without understanding the risks. Some are long bull markets or tech booms or credit bubbles. It works until it doesn't. Then they blow up, and often they don't even understand why. Success in one regime isn't the same as true investing mastery. If your results are style dependent, you might be confusing luck with skill, just on a bigger scale. Always ask yourself, am I good at investing, or am I good at investing in this environment? The difference can mean survival or ruin. If you think I'm being too pessimistic, or that investing isn't such a zero-sum game, I only have one last thing to ask you. Talk to some old-timers. Ask them if they've ever known somebody who could beat the market consistently. Someone who was just an average Joe, not a professional. Then ask them how many people they know that have blown up a trading account. In other words, lost it all. The number should be a very large ratio, maybe 1 to 100. So that leaves you. You really want to be a professional investor. Someone who is paid to invest. Someone who gets high returns, low volatility, or ideally both. I can show you what I've learned. I spent my whole life learning investing from practice and first principles. Who am I? What are my credentials? I started as an intern working for a fund called Kramer Berkowitz. This is Jim Cramer of Mad Money's hedge fund. A lot of people ask me about Cramer. I think he was an amazing trader. In fact, I know he was. He made more than 20% average annual returns, net of fees, which is an amazing record. I only overlapped with Jim for about a year before he retired. But I have to say, he's a great man, incredibly smart, talented, and generous. I don't talk with Jim anymore, but his style of trading was very specific to a certain era on Wall Street. But it helped me learn the basics of the market. I then joined an investment bank, UBS, working with my friend and a value investor named Ed Painter. Ed worked at Salomon Brothers. We worked together afterwards, and Ed has proven to be a successful entrepreneur and investor. I've spent thousands of hours chatting with Ed, debating markets and learning. After that short stint, I went to work at a so-called tiger cub called Intrepid. I'm proud to call Steve Shapiro and Ari Glass, the bosses of Intrepid, my friends 20 years later. I wasn't there too long either, but this is a really pivotal time in my growth as an investor. I started a hedge fund in 2006. In hindsight, I started too early. I still had more skills to build, more lessons to learn. The fund didn't do well, but it gave me a priceless education. How to deal with corporate management on the highest level, how to think like an owner, how to make tough decisions as a controlling shareholder. I worked with a very wealthy investor. I made a very large bet that the market would crash in 2007, about a year too early for the great financial crisis. The experience hurt, but I spent the next few years licking my wounds. I worked with my college friend Mark in the next few years, managing some of his money and getting very cerebral and philosophical about stocks. Some of the downtime during the great financial crisis was actually the best time to ask really deep questions and think about what stocks and investing in general was all about. We studied just about everything about Warren Buffett and other great investors had done during this period. Finally, I started a drug company, which operated a little bit like a private equity company, where M&A was a co-equal focus to R&D. I also personally invested at this time. This was my really successful period where everything seemed to come together. I was doing private equity style deals with my drug company, but also trading and investing for the drug company and myself. At around 32, I finally mastered the markets. I went to prison for reasons that I believe are unfair. I fought the government very hard and nearly beat them. I don't ask for sympathy. I'm doing very well right now, and I'm at the top of my game. I'm here to teach you about what I know without asking for anything in return. Sometimes I get asked why I ever did these videos and how they were received. I know millions of people watch my videos, and I get thank yous from them every single day, many times in person on the streets of New York. Many people who watch my videos have become billionaires, but of course I don't take credit for that. Those people would have succeeded with or without me. But I'm so proud that so many entrepreneurs and investors feel like the videos have helped them, even a tiny bit. The only self-interest I had at the time in 2015 was that I wanted people to see the real Martin Shkreli. I was being thrashed in an era where major media could still cancel someone. Live streaming was brand new, and the idea of being an influencer was just getting started. It would be years before you could be vocal and tell your own story. But I tried, and I think it worked really well. I also was happy to share what I knew. I knew many bullshit books were out there and were uninformed, and there were downright scammy lessons that were on finance and investing on the internet, many of which you had to pay for. Today, I have the same agenda. I'd like people to understand me a little bit better and learn whatever useful things I have to share. I also have another motive. I've created investing research software, and I would love for you to use it. I've tried to use a smattering of different tools throughout the videos, though. You'll see my package works similar to other software packages out there, and you're free to use whatever software you want. Most of my work is done in Microsoft Excel, which I unfortunately don't own, but I use a lot of the free resources out on the internet. Now, if you're serious about learning about investing, you have to commit to learning from the best. I think one of the best ways to learn investing is study Warren Buffett, Steve Cohen, and Jim Simons, David Shaw. Understand how the great investors think, not how the TikTok or YouTube day traders gamble. You should build a real academic foundation. Start maybe by reading finance journals, the academic journals like Journal of Finance. You don't have to memorize every equation, but you should know what the smartest people who are publishing in these journals are thinking. I also recommend you read the basic textbook on finance, like Brealey and Meyer's Principles of Corporate Finance. I think it's something that I started reading when I was 14, and it helps a lot to know the basics of discounting cash flow and things like that. There are a few other key books I can mention, like Margin of Safety by Seth Klarman, Common Stocks and Uncommon Profits by Phil Fisher. DeMataran's website is really great, and he's someone that has given a lot to the value investing instruction community. Above all, I want you to develop skills that will serve you no matter what, like thinking independently and having the discipline to question everything, including yourself. There's no shortcut, no guru, no paid course. Nothing will give you those things. There's another skill I want you to think about and nobody wants to talk about, which is to be brutally self-aware. Knowing your own strengths and weaknesses, understand your own psychology, this matters more in investing than raw intelligence. The actual practice of investing, studying companies, analyzing stocks, is relatively simple. What's hard is putting that knowledge into action with real discipline, especially under emotional pressure. You need to constantly ask yourself, am I overconfident? Am I anchored to bad information? Am I chasing returns? Am I lying to myself about my real risk tolerance? If you can't stay honest with yourself, the market will do it for you, and it will hurt. Investing rewards the self-aware, the humble, and the ruthlessly disciplined. Not the smartest, not the loudest, not the most confident. There's another thing that can accelerate your journey, but only if you do it right, which is finding a mentor. If you're serious about getting better, you need to find someone who's actually done it. someone who's made real money from investing, not just talking about it. In my view, you shouldn't even consider somebody unless they've made $100 million or more through investing. That might sound impossible, but it's not. Greatness often finds a way of meeting greatness. Palmer Luckey, the founder of Oculus, found John Carmack, one of the greatest programmers of all time, on a message board. Albert Einstein, as a young nobody, found support and advocacy from Max Planck, the most famous physicist of that era. You don't need thousands of mentors. You need one who's the real deal, and you need to show enough potential and persistence that they want to help you. But in my experience, I've found that a lot of these people do want to help, but you have to, find them and be persistent, and eventually it should happen. A real mentor can save you years or maybe even decades of trial and error, but the burden is on you to be worth mentoring. Before we wrap it up, I just have one last thing I want you to think about, which is burnout. Most investors, even the most successful ones, realize a few years into their careers that they don't actually want to spend the rest of their lives reading 10Ks, researching companies, and grinding through financial statements. These are good skills to learn. They'll make you sharper, more analytical, more independent. Maybe you can work in the corporate world or as a broker. But if you don't love investing, especially the way I'm proposing you go about it, think long and hard before you commit to this path. Of course, day trading is fun. It feels exciting. It feels alive. But it's not profitable over the long term. The kind of investing that I'm trying to teach you is a little bit painful. To be really profitable, there'll be pain, long hours, doubt, frustration, boredom. But investing isn't about chasing returns. It's about building it as a discipline you can live with every day for decades. I'm 42 now. I started investing when I was 12. I begged my father to open an E-Trade account for me with the $2,000 that was required. That small start taught me something really huge, which is capital is important, but skill is everything. I was a poor kid from Brooklyn. I didn't come from money. I didn't have any connections. I knew that if I wanted to succeed, I couldn't rely on compounding that tiny account, even though I tried. I had to master the markets. I started working at a hedge fund, which I mentioned earlier, when I was 16. I got an early view into how investing worked. Not the fantasy, not the hype, but the hard, dirty work of real professionals trying to outsmart and outthink each other. Looking back, I wish I'd stayed even longer in apprentice mode. If you have the chance to learn under really great people, you should take it. Skills come before capital, always. Throughout the series, I'll try to point you to the best resources and show you how real investors think. It's a long road, and I'm happy you decided to go on it. That's it, 22 minutes. What do you guys think? Oh, video 2 is next. There's like 80 of these things. Okay, so better call to action. Maybe like the next video is on